Hello everyone, my name is Garrison Weaver, and I prepared the following video to provide an overview of the commercial mortgage-backed securities market. Commercial mortgage-backed securities are a type of securitization comprised of a pool of first lien mortgages for commercial properties, as opposed to ones backed by single-family homes. Securitization is a process by which pools of assets are repackaged into fixed income securities that can be efficiently distributed into the capital markets. CMBS plays a significant role in the commercial and multifamily lending market as a provider of first lien mortgages for a wide variety of property types spanning primary, secondary, and tertiary markets across the country. The product allows access to commercial real estate debt investment opportunities for different types of investors with benefit of a credit rating, credit enhancements, and providing secondary market liquidity for the instrument. The liquidity of CMBS bonds for investors can be a clear benefit as compared to liquidity profile and capital requirements of whole loan alternatives. For institutional investors seeking exposure to commercial real estate without direct ownership, CMBS provides borrower, geographic, collateral diversity, in addition to exposure to different levels of risk and yield for a range of risk-adjusted returns. Through decades of experience, including several market cycles, CMBS structures, underwriting, and reporting, have evolved and contributed to increased standardization and transparency, both within CMBS and across the wider commercial real estate finance ecosystem. The transparency created by the CMBS has been one of the factors that has attracted more institutional investors to commercial real estate generally. In the aftermath of the savings and loan crisis, commercial mortgage securitization emerged as the dominant source of new financing by the property market's peak in 2007. Commercial real estate, like so many other asset classes, suffered during this time due to lower economic growth as well as significant job losses. Many of the most aggressive projections that have been made while underwriting loans before the recession did not materialize. The impact on commercial real estate performance and CMBS loan performance was significant. By the mid-2000s, CMBS originations had reached approximately 50% of the commercial real estate finance origination market share. Issuance of commercial mortgage-backed securities fell during the financial crisis from $229 billion in 2007 to just $3 billion in 2009. Over the last few years, issuance has grown modestly and continues to account for about 10 to 15% of mortgage volumes. When you get a traditional commercial real estate loan, you approach a lender, receive funds, and pay the loan back to the lender over the course of several years. However, when you get a conduit loan, the loan will be packaged with other commercial mortgages into a trust known as a real estate mortgage investment conduit, or a REMIC, and sold on a secondary market to investors. This process is known as securitization. This is why loans are referred to as commercial mortgage-backed security loans. After your loan is sold to investors, this changes some of the aspects of how the loan will be administered and who will be dealt with when making payments or changing the loan. The originator sources, screens, and underwrites mortgage loans and ultimately lends money to the commercial real estate borrowers with the goal of selling the loan as a whole loan seller to the security issuer. This role could be either an independent mortgage banking firm or an employee of an investment bank that structures and sells the bonds. The issuer, generally this investment bank, sells the bonds that are supported by cash flow from the pool of loans. This is generally in the role of large investment banks that design the credit enhancement and composition of the pool of loans to make the bonds more attractive to the eventual investors. The master servicer is a commercial mortgage servicer that manages the day-to-day servicing of the loan. Beyond collecting payments, this includes managing any escrow accounts, inspecting the property, reviewing requests from the borrower, and creating financial statements for the loans. In some cases, a master servicer may subcontract these responsibilities to a primary or sub-servicer. Special servicer. If you stop making payments on your loan or it goes into default, it will be given to a special servicer. These can work with you to modify or change the loan terms as long as it's in the best interest of the bond investors. This includes changing the loan terms, deferring or forgiving interest or fees, foreclosing on the property, or allowing substitution of collateral or the assumption of the loan. The loan is transferred to a special servicer, and appraisal will be needed to perform, often at the borrower's expense. Investors in the CMBS product may purchase bonds up and down the capital stack that carry different risk, investment grade to below investment grade or unrated bonds. To simplify, it can be thought of as three categories, although an investor might purchase bonds in more than one category. Investment-grade investors acquire bonds that are the most senior in the capital stack and are most likely to get repaid given their place in line. The senior bonds are also paid the least amount of interest compared to the more junior bonds given their lower default profile. Mezzanine purchasers purchase bonds that are neither the most senior nor the most junior in a CMBS transaction. The purchaser of the most subordinate bonds is known as the B-piece investor and is granted certain contractual rights as the holder of the first loss position, in addition to a higher yield given the risk profile. Most conduit loans have a balloon payment at the end of a term of 5 or 10 years. However, the monthly payments will allow for a 20 or 30-year amortization. This means that the monthly payment will be equal to what you would pay if the loan had a 20 or 30-year term, but you will pay the loan off in 5 or 10 years instead. The last payment on the loan will be a balloon payment where you pay back the remaining principal and interest. Once the originated loans are pooled together and the bonds are issued, the cash flow from these commercial mortgages is split into different classes of bonds, which provide investors with different risk-reward opportunities via different pricing and payment priority to each asset class. The senior investors in line to be paid interest and principal first take less risk than the most junior investors who are in line to be paid principal and interest last, and the price paid for the bonds generally reflects these dynamics. Each of these different slices of risk are known as tranches. Some investors require specific rating agencies to rate their investments to comply with their organizational documents. These agencies analyze the credit of CMBS loans and transactions and issue ratings in addition to reviewing servicer operations. Ratings are assigned when bonds are issued and in addition, maintained and monitored during the life of the CMBS transaction. Credit ratings criteria are instrumental in determining the makeup of securitization pools since the investment grade rating is so important to so many investors as well as the issuers. The agencies rely on transaction information provided by servicers to conduct surveillance of their existing ratings and loan performance. The result of this sequential payment of interest and principal is that any losses on loans backing the CMBS security are allocated first to the most junior classes. This creates a cushion for senior bondholders known as credit enhancement or credit support, a key factor in credit ratings for CMBS. Other key factors that play a role in analyzing the risk inherent in CMBS transactions for rating agencies and/or investors typically include commercial real estate finance calculations such as loan-to-value ratios, debt service coverage ratios, and debt yields, as well as the pool characteristics such as market, property type, and borrower concentration, and risk mitigants built in the loans in specific CMBS transaction. Some of the risk mitigants are built into the security itself. Generally, there are 3 types of mitigants known as credit enhancements that are features of the securitization that protect CMBS investors. The first is subordination. Subordination is the process of prioritizing the order in which mortgage loan losses are allocated to the various types of bonds so that the lower rated junior bonds serve as credit support for higher rated senior bonds. More specifically, all principal losses on the underlying mortgages go first to the junior bonds, resulting in a write-down of their principal balance. Similarly, any interest shortfalls will affect the most junior bonds first. Under the collateralization method, the face value of the underlying loan pool is actually larger than the par value of the issued bonds. So if some of the payments from the underlying loans are late or in default, the transaction may still pay principal and interest on the bonds. For example, if an analysis of a particular collateral's pool expected performance indicates that the pool would need 40% credit enhancement to support a AAA rating, then this rating could not be obtained unless the transaction had 40% more collateral above and beyond the par value of the securities issued. So if the collateral value of the pool was $2 million, it could only issue $1.2 million in AAA rated securities. If the collateral performs poorly, for example, by incurring 30% losses, it would still leave a cushion of 10% to cover the losses from further defaults. So here there is no transformation of poor credit assets into solid investments. Instead, in our example, a transaction has $2 million in collateral to support $1.2 million in AAA rated securities. Finally, excess spread is the additional revenue generated by the difference between the coupon on the underlying collateral, such as the mortgage interest rate, and the coupon payable on the securities. For example, when borrowers whose mortgages are in a given collateral pool may be paying 7% interest, while the coupon of the mortgage-backed security may be paying 4%. This transaction can then use the excess spread to absorb collateral losses or build over-collateralization to its target level. Generally speaking, once the transaction has used the excess spread to cover losses for the month, whatever monthly excess spread it doesn't need to build over-collateralization target is allocated to a residual certificate. Whatever method a transaction uses, credit enhancement allows for more resources or financial backing for a security that will be available from the underlying assets alone. Okay? If the pool ends up experiencing losses, credit enhancement supporting the bonds should be able to provide enough cushion in the transaction to allow for payment to the bonds. Because it provides a kind of safety net, credit enhancement increases the likelihood that bonds with a higher payment priority, the senior bonds, will receive full payment of principal and timely interest. Conduit loans normally have a lower interest rate when compared to traditional commercial mortgages, and most have fixed interest rates. The rate will generally be based on a U.S. Treasury swap plus a margin. Your creditworthiness, the value of the property you're purchasing, and the strength of your business will affect the margin. Another thing that's attractive about these loans is that they're non-recourse and assumable. A non-recourse loan means that a borrower is not personally responsible for repayment of the loan. This means you won't have to make a personal guarantee when you take out the loan. The main exception to this is what are known as bad boy carve-outs, meaning if you intentionally cause harm to the property, conduit lenders or investors, you become personally liable. Secondly, many of these loans are fully assumable. This means that if you decide to sell the property, the buyer can take over the loan for you, releasing you from any obligation on the loan. However, some conduit lenders charge a fee for allowing the loan to be assumed by another borrower. Loan assumption normally occurs when the loan on the property has a below market interest rate, as it helps the buyer save money on financing the property. One downside to conduit loans is that borrowers generally have less flexibility in negotiating terms. This is because the trust overseeing the securitization of the loans must comply with certain tax laws. In addition, once the loan documents are signed, borrowers have little recourse to change terms or features of the loan, again due to tax laws governing the trust. Unless the loan is in default, borrowers should think carefully about any future financing needs for the property they're purchasing before they take out a CMBS loan. In addition, CMBS loans typically do not permit secondary or supplemental financing, as this is seen to increase the risk to CMBS investors. CMBS loans also come with significant prepayment penalties, defeasance, and yield maintenance that are unique to this market. In addition, in the case of CMBS yield maintenance penalty, the borrower pays a penalty for refinancing the loan or paying it off early. This allows the lender to make the same profits that they would have made if the loan had been paid off within the agreed time frame. In this instance, the borrower's note is canceled and the loan is paid off. In contrast, CMBS defeasance penalty does not allow for the loan to be repaid or the borrower's note to be canceled. In the context of a CMBS loan, defeasance is the process by which a borrower is released from the obligations associated with the debt through the purchase of a portfolio of securities, the proceeds of which will be sufficient to make the remaining interest and principal payments on the mortgage loan. This portfolio of securities serves as the replacement collateral for the borrower or the properties under the loan. Lenders typically won't allow borrowers to defease their conduit loan until it has been outstanding for at least 2 years. The rules for issuing CMBS have changed significantly since the collapse of the real estate market in 2008. CMBS issuers now must abide by a risk retention rule that requires an issuer to maintain skin in the game by retaining at least a 5% share of any security deal issued, as determined by its fair market value at the time of issuance. CMBS issuers can meet the requirement by choosing to retain the portfolio of each investment tranche, which is known as vertical retention. They can also meet the requirement by retaining a share of the junior tranche, dubbed horizontal organization, or through a mixture of the two approaches, they can retain the L-shaped retention. Requiring issuers to retain an interest in the loans they originate means the issuers share in any losses that occur. This is a strong step in creating alignment with investors who purchase the bonds. The CMBS marketplace provides a liquid, viable, and transparent funding method for larger borrowers and for a range of global fixed income investors. It has helped fuel the growth and stability of the commercial real estate market by providing attractively priced loans for borrowers while providing bond investors with lower risk investment opportunities at attractive yields. I hope this presentation has provided you with a good overview of the CMBS market. Please feel free to contact me at my email below if you have any questions or comments. Thank you.